It took me 5 long years to become really successful at day trading. If you know my story, I started day trading, or at least dabbling into day trading back in 2014, and it wasn't really until 2016, 2017 where I got really consistently profitable, where I could really make it a real-time job. So what were the two biggest strategies that it took from me going from 2014 on what I was doing and losing money consistently until I finally was able to start making consistent money? Well, don't worry, I'm going to be breaking down for you these two strategies that took me over 5 years almost to learn. Well, you'll be able to cut all that time and be learned from me. So make sure you watch this whole video. Going to be a lot of information in here. Hit like, comment down below, subscribe to the channel, come check out the other social media pages, and as always, let's get straight into the video. First one is liquidity grab versus liquidity formed. A lot of us try to understand where liquidity is, where supply and demand are, where is the market trying to get to, so that it can grab that liquidity and then go the other way. So why is that very important? Because liquidity grabbed versus liquidity form will let you not too sure where there's about to be a breakout. So let's first analyze this by showing you guys a couple examples without getting on the charts. So liquidity grab, so let's call this LG, is simply when the price makes a V-shaped recovery. Kind of as you can see here, on this charts or right here. So this is a liquidity grab, price goes there, touch it, and goes down. Now, a liquidity form is actually when price gets offended. When price, let's call this now, we'll move this to the side, we'll call this liquidity form, LF. So LF is, let's say price goes down, and then you see a price of sideways action. Kind of like you will say something like this. So now the liquidity is formed not actually here, but right before that level, right? So the liquidity wants to come down to this level, retest this level, and then go up. It does not want to come back into this area. So liquidity form, liquidity grab, really important to understand, because you don't want to get caught shorting at the wrong level or long in the wrong level, and then you're gonna just lose a ton of money. Here, for example, we see this 1 hour chart on the SPY making this quick V-shaped move here, strong move up, and then V-shapes down, right? So now that is a liquidity grab. They grabbed liquidity and came down. You do not want to mark this level for a short position or a long position, whatever if it was upside down. The reason is because the liquidity grab is not liquidity form. There's no liquidity there to grab anymore. It was already grabbed, as the name says. So people will start shorting in this level, and guess what happens? It gets cut right through it, as you guys can see here, and you lose all money. And you're like, well, I was trying to short the resistance, the demand area, the supplier, whatever you want to call it, but it just didn't work out and I lost some money. Now let's talk about a liquidity form. Let's find a different example of this liquidity form like I talked to you guys about, and let's take a look at right around this level. So you guys can see in this box here, you see price consolidating within 415 to around 417. It's an hourly time frame, so this consolidation will be a little bigger than if you were at a different time frame, but let's just take it for example. So now, as I told you guys before, what did I tell you guys before? I said if the liquidity comes down, right, it makes this, in this case would be on the upside, so let's make it like this. Where's the liquidity? Think for a second, where would you put the liquidity? Is the liquidity right here? Or no, it's not, right? Like I told you guys, the liquidity is going to be right below it. So it's not right where it is, it's going to be right below it. So if this is our box, where is the liquidity going to be formed once this price falls, right? It's going to be formed right here. So this is going to be your liquidity, right? This big move here. And if you trade ICT, if you trade smart money concepts, you might call this a fair value gap, right? You might have heard that term. Guess what? It's just a liquidity created. It's a very simple, I want to say simple, but it's a term that has been around for a long time. ICT was just smart and call it a fair value gap, whatever. It just means price needs to go retrace there and then come down. And guess what happened? If you'd shorted this level, right? If you shorted this level right below where this was formed, guess what happened? You could have shorted here and let it run down. Again, this is an hourly time frame. Keep that in mind versus a smaller time frame. But what can you do? What can we do, right, to understand where these levels are going to be formed? What are some things that we can do to understand these levels are going to be formed? Now let's talk about how can we understand where this liquidity has been created, because it's obviously not as easy as a liquidity being grabbed. Liquidity grab, it's very easy. You look for this level, you see these big wicks with V-shaped type of moves, and then you see kind of push through, right? And then you can see another one here, and so on and so forth. But the liquidity being created is not as easy. It's not as easy. Yes, we can establish our consolidation area, but then where do we establish where the price is going to retrace before entering? So you establish this level, right? And this is the number one way I like to do it, is use the tricky golden pocket. If you don't know how to use a Fibonacci golden pocket, I have some videos on it, but as you can see, if we draw it right here, I always like to kind of create it between the 0.5 to the golden pocket area. So in this case, it would have been right around this level. And as you can see, it coincides with this big level of imbalance. Like I said, it could be called fair value gap, whatever you want to freaking call it, whatever this price here that you only got sellers. You have to think about this. The stock market is a big old order book where price of buyers and sellers are trying to find the balance between an asset. Now, where there's only sellers or only buyers, it's going to create those imbalances that need to come back and retrace. When this being the level defended, where you have this liquidity created, right, is the level where the real smart money, the real big banks have placed. These are not the levels where they've placed. They placed all their orders right in here. The best way you can think about it is think about this as a castle. Now, I'm going to throw out the worst looking castle in history, and their whole job is to defend this castle. So they don't want to defend. You don't, as a castle owner, you don't want to defend as you're getting attacked. You don't want them to be inside your castle attacking, right? You want to defend them at the walls, before the walls. In this case, as you can see in here, it could have been here, could have been here, right? And then the more times you can think of this is, if we drag this all the way across, as you can see, these rejection areas here are the reason we rejected, because you had this liquidity formed right here. And the more times you attack this castle, right, you attacked it once, you attacked it twice, you attack it 3 times, the more times you attack it, the more likely it is, as you can see here, to be broken through. The castle has been broken through. And that is the big difference between liquidity grabbed versus liquidity created. It's not an easy concept, but you do have to understand that it is going to be your key difference between how to not get trapped in shorting this type of areas where you get destroyed. Again, here, if we go here, guys, liquidity grab, V-shaped recovery with the big wicks. Guess what happened here, right? You see it, but look at this. Now, if we draw this area where we consolidated, guess what? You came back to this area and you could have longed, right? You can see you can take a long position here and then it went to post market and then gap down. But just for you, show you guys a couple examples here on how to do liquidity grab versus liquidity created. This by far was the #1 thing that I had to learn. It's really 2 things combined into one, really, but it's 2 things that are kind of related. But once I understood this, I was able to take my trading to the next level, understanding where I should be short, where I should be long, and where to look for continuations or reversal patterns. If you like more educational videos like this is a short one, make sure you hit the links down below. I'm watching my position move right now, so I'm focused really on that. But if you want to come make money with us, because this play was alerted everybody, SPY calls, or sorry, QQQ calls are up a little over 100% right now. Hit the links down below. Join our Discord, trade me live every single day. Ask me any questions you want on there. And as always, peace.